Okay, good afternoon, folks. My name is Peter Armitage. I'm the Chief Executive of Anchor Group. I would like to welcome you all to our webinar today. It's the first in a four-part series concerning investing offshore. We've got a great panel, group of 7 of our offshore fund managers and analysts. We're going to take you on a little trip around the world. We've got guys sitting in Cape Town, London, Johannesburg. So hello to you from a sunny Johannesburg. Where we sit in the world at the moment is the investment market is a difficult place. There have been some very dramatic moves in markets, and those who've kind of stayed the course through equity markets over the course of the last 12 to 18 months have been handsomely rewarded. However, markets are close to all-time highs, and we've certainly seen a changing dynamic in terms of the types of investments in businesses. In many businesses, futures have been accelerated. So when we take money offshore, and I think it's kind of common wisdom that one needs to diversify one's investment portfolios internationally, we certainly spend a lot of time with financial advisors and with clients helping them externalize capital, given that South Africa is just 1% of the world. But when you look at equity markets, they're pretty expensive. There isn't much of a yield in terms of underlying investments. It all looks pretty complex. However, if you could get down to the coalface and join us when you hear our fund managers talk with some passion about what they're investing in, you'll realize that there are still some very investable assets out there, and we think some pretty decent returns over the course of the medium term. What should one be expecting from equity markets? I think global wealth creation is effectively done in equities. Over time, you've achieved about 8 to 10% per annum in dollars in the US. And from a global perspective, shares have really been the place to be. We don't expect the kind of returns that we've earned over the course of the last 5 years to be repeated. That's about 16, 17% per annum in our global equity fund, about 14% in our high street equity fund, and you'll hear a little bit more about those. However, we do think that equities is the place to be, but at a point in time, and investing new money at the moment is a little bit more complex given the valuations. We always think that some diversification makes sense. And Nolan Wapenaar will talk you through global income markets who can achieve kind of 2 to 3% returns at much, much lower risk. And from an equity market perspective, we think it's time to be selective. We do have kind of a core investment philosophy, and we've got some fund managers who follow some quite specific investment approaches. And a blend of those has tended to make sense for our clients over the course of the last 5 to 10 years. We also think, and this becomes very much an individual perspective, is alternative assets are starting to make a lot more sense. And depending on the kind of risk profile that you're prepared to take on, we've got a range of alternative assets that we access across the globe, offering prospective returns in the kind of 3 to 15% range. That would include specific structured products. We create something for a specific client or fund, hedge funds, which offer some nice uncorrelated returns, and our hedge fund suite has delivered some great returns over the course of the last 5 years. And then in anchor tenant, we are offering clients specific property opportunities, which we must align to a client's risk return appetite. So that's kind of the world of investment. And you take your $100 offshore, lots of different places to invest, lots of exciting growth businesses around the world. But before one starts, you need some advice, and you need to assess where you should be on the risk-return spectrum. And I'll hand you over to Darryl Hannington, our Head of Portfolio Management, who will take you through some of the basics before you actually deploy the cash.
Thank you, Pete, and afternoon, everybody. As Pete's already mentioned, my name is Darryl Hannington. You're going to be hearing from a couple of the different fund managers that we have inside of our business, talking across their various asset classes. But before we get there, what does it all mean? I think as a starting point, as a portfolio manager, as a financial advisor, as anyone who's handling someone's well-earned money, you need to take a step back before everything starts, before making any investment, and understand that each of our clients has got completely different constraints, completely different objectives. And so when looking at the bigger picture, there's a few important things to consider prior to making any investment, both locally or abroad. Part of these constraints, part of these objectives are, well, as a starting point, what is the time horizon for the investment that we're talking about here? And intricately linked to that time horizon is how likely is it that our clients are going to need to draw an income or have access to some of this liquidity along the way. The reality is that in what we do, time is our greatest ally. And with a longer term time horizon, it gives our clients the ability to invest up the risk curve, to expose themselves to asset class that demonstrates higher short-term volatility, but will generate better long-term returns. So that gives us the willingness to invest up the risk curve. But gives us the ability to invest up the risk curve, but are our clients willing to do that? And this is an incredibly important consideration when we're formulating anyone's individual investment plan. Other things to consider is, who's this money for? What is this money for at the end of the day? Is this money to be spent during our client's lifetime? Is this multi-generational? So in that instance, what are we talking about when it comes to estate planning? What are the tax considerations that we need to consider on behalf of our clients? Are our clients taxable in South Africa? Are they taxable on worldwide assets? These are all very important considerations. And at the end of the day, what are the return expectations that our clients have? Because trying to marry risk and return and how much return are you after and how much risk are you willing to take is of paramount importance. Getting that right up front is crucially important. And then, especially when investing in the offshore markets as a foreign investor, as a South African investor, which most of our clients are, you need to make sure that you get the structure right up front. And as far as I'm aware, and in future webinars, this will be dealt with extensively. Getting the structure right up front goes a long way to maximizing long-term after-tax returns, providing for your estate and for future beneficiaries of your hard-earned money. I'll hand over from here on out to our fund managers.
Right here. So first up, we've got Nick Dennis. Nick is South Africa's top offshore equity fund manager over the course of the last 5 years. His global equity fund won the Raging Bull Award in 2020. And Nick's got a very specific style. You know exactly what you're getting when you invest with Nick. And I think for those of you who followed him over time, certainly massive enthusiasm and belief in the way he invests and what he's setting out to achieve. And he certainly achieved those results along the way. So let's hand it over to you, Nick.
Thanks, Peter. Thanks for the introduction. So if there's one word that I use to describe the way I manage money and the way that I manage money in the Anchor Global Equity Fund, it's multi-baggers. So what is a multi-bagger? A multi-bagger is a company and a stock that can go up, that can grow its business, and then hopefully the share price, say 5x to 10x over the next 5 to 10 years. So it's names like Netflix, Amazon, Tencent, Naspers, those kind of companies. And what I'm trying to capture with this graphic is that to find these companies, you really need to lean on both sides of your brain. So traditionally, fund managers like myself, we often come from an accounting background, and we tend to lean on the left side of the brain, very spreadsheet-oriented, very logical, very numbers-driven, and that's all fine. But actually, what you also need is you need to tap into the right side of your brain and tap into the creative elements, intuition. You need to use imagination to see where the company can become, where it can reach over time. And a lot of these companies, if you think of an Amazon or a Tesla, for big chunks of their listed history, they've been controversial stocks and often polarizing companies. So it's not easy to identify them, and it's not easy to stay invested in them. And so that's why you need to use both sides of your brain, and you also need a lot of temperament and independent thinking. Thanks, Pete. So there's always a lot of noise around, today there's a lot of noise around inflation. And before that, there was noise around Trump and the Euro crisis and China, et cetera, et cetera. But what actually matters in terms of generating value and what matters in terms of generating long-term wealth. And this is what matters for creating multi-baggers. And really the starting point is a better product. So if you consider like a Netflix or a Spotify or an Amazon, you get this massive range of selection, and it's cheap and it's convenient and it beats the legacy alternatives. And when you've got a better product, that leads the company to gain market share, which leads to more revenue and more cash flow. And this next part is really what differentiates multi-baggers from just your run-of-the-mill companies. Your traditional companies, your legacy companies, will typically take that cash flow and then they'll pay it out as a dividend, or they'll buy back their shares. But what these great companies do, the multi-baggers, is they take that cash flow and they reinvest it back in the business. So they'll reinvest in making the product better, they'll market, they'll open new distribution channels, and they'll hire the best talent. They'll hire the best people. And so what you get is this virtuous circle, which turns and turns and turns at an accelerating pace. And typically the market underestimates this process and underestimates how long and how fast these companies can grow for. And essentially, this is what I'm looking for in these companies. So what's an example of a multi-bagger that sits in the portfolio and that has been a fantastic returner for the fund? One example is a company called C, which is headquartered in Singapore, but it's listed on the US exchange. And C has been roughly a 10-bagger for the fund over the last, call it 2 years. So that's been roughly 1,000% return for the fund. And C really exemplifies what you find in a multi-bagger. So they started with, they've got two big parts of the business. The one is a gaming business, which sits under the Garena banner. And then they've got an e-commerce business, which sits under the Shopee banner. So C is building something like a combination of a Tencent and an Amazon right across Southeast Asia. So what they're doing is they've created this hit mobile game called Free Fire. And that's been a huge success, not only in Southeast Asia, but now in Latin America and India. What they're doing is they've taken pretty much every last cent from the gaming business and they're reinvesting that in Shopee, the e-commerce business. And that's propelled them to a market-leading position across all the major markets of Southeast Asia. Now, it's been a phenomenal stock, and at several points in time, it might have been tempting to sell it and lock in gains. But I still think that there's a really bright future ahead of C, and I think this company is only going to go from strength to strength. So this kind of illustrates what I'm looking for in the fund. And I still see, despite markets at all-time highs, I see plenty of opportunities like C on a prospective basis. With the rise in interest rates, the US 10-year yield, with the sort of, I think it's hyperventilating around inflation, we've actually seen a mini bear market in a lot of these high-growth companies, which is not surprising after the strong run that they had last year. And I think they're potentially setting up for future strong returns over the next couple of years. So yes, I understand that people may be concerned about markets at all-time highs. It's never a straight line, but I think just given the opportunity sets with these potential multi-bagger companies, I see every reason to be bullish. And with that, I'll hand back to you, Pete.
Yeah, thanks, Nick. I guess an interesting way to look at it is, if you look at some of these really fast growth companies, which have come off 20, 30% this year, at the same time, if they're growing their earnings by 20, 30% in a year, by the time you've got to the end of the year, they're kind of 50% cheaper. So some big opportunities there. I'm now going to hand over to Mike Gresty to talk about our high street equity portfolio. This is our, I guess, a little bit more conservative and more traditional segregated portfolio approach, which has achieved some nice returns over time. But I'll let Mike tell you where we think the opportunities are.
Great, Pete. Thanks very much. Yes, so I'm talking about the high street portfolio. And as Pete mentioned, this is what we call our segregated portfolio. So what that means is this is essentially our model portfolio for an investor who wants to invest and own shares directly. So it's not really a fund as such, but the investor will own these shares directly. And how do we put that fund together? So essentially, it's a diversified portfolio of between 20 and 25 companies. So we're trying to ensure that we have a meaningful exposure to the companies that we select. In terms of our core philosophy as to which, what are the bulk of these companies comprise, We borrow liberally from Einstein's quote, as in what is the eighth wonder of the world, being the power of compounding. And essentially what we're looking for are companies that generate high returns on the capital that they employ, and they're able to compound those high returns to deliver superior growth. So obviously in the good times, you would expect those companies to outgrow the broader market in terms of their underlying performance. But it's also important to understand what that means in the bad times. So where you contrast that with let's say a company with very low margins, very capital intensive, when times go south, you run the risk that those companies may not survive. For sure, these high return companies we invest in are not immune to difficult times, but you have the confidence that the margin of safety that they represent means that they will still be operating. And as Pete mentioned earlier on, our aim here is to ensure that while we're achieving superior growth, we're also ensuring that clients' money is safely invested. We obviously look in doing this to ensure that we are well diversified geographically, and that we do partly by picking companies in different jurisdictions. But you'll see when we show you the portfolio just now that many of them are actually global platforms. We consciously try to avoid replicating South African exposure. And again, you'll see that demonstrated when I show you the portfolio just now. You're going to see a number of the experts talking. You've just heard one of them, and we draw liberally on their expertise in terms of the investments that we pick. And as time goes along, we maintain a decent degree of flexibility to take advantage of opportunities as they arise. I think one good example of where we did that was in the early stages of COVID. We identified a number of opportunities, which we got into, March, April of last year. We've exited most of those now, but in all cases, they delivered nice returns. We're currently sitting on quite a bit of cash as we've exited those opportunities, and we're busy evaluating a number of new potential investment opportunities, and we're going to be potentially implementing those quite shortly. What do we seek to do? This is certainly a growth-orientated portfolio, as you'll see, and the aspiration that I certainly have is that every share in that portfolio should be delivering over the longer term a double-digit compound return in dollars. That's my sort of benchmark as to how I think about what each seat on the bus must deliver. Now, just in quick run through our sort of rhythm of investment process here. So we meet every Thursday to run through the portfolio, run through news on the companies. In any given quarter, you're probably spending about 4 to 6 weeks in terms of the intense reporting period. A lot of the companies we invest in do report quarterly. And so there's all the reassessment as to whether the investment thesis that we have still holds true. And then that gives you the balance, let's say half of the quarter really left aside for looking at new ideas. And we meet by and large every 2 weeks to evaluate new investment opportunities. It's not really our aim to churn this portfolio rapidly. We're trying to keep the costs down, but we are constantly on the lookout to ensure that every share in the portfolio has a good reason to still be there. So this is a portfolio as it stands at the moment. I think we're currently sitting with around 23 positions. As I mentioned before, a lot of those are your big, well-recognized names, hence the name, High Street. You will see, perhaps more important to say, what do you not see here? You don't see much exposure to industrials. We don't really like the high capital intensity and return profile of those businesses. You don't see any exposure to materials or mining. And really that plays to the fact that we think you can adequately get that exposure through South Africa. You'll see there, and probably the new innovation in this fund is exposure to a couple of funds within it. It's certainly not the intention to convert this into a fund of funds, but we do think that in terms of EM exposure, emerging market exposure, to the extent that we want it and we keep it quite managed, we would rather do that through a diversified fund, so to speak, in which we're able to trade quite aggressively. You also see the Anchor Global Equity investment there. That's managed by Nick, who you just heard from just now. And certainly we think that Nick is better equipped to use both sides of his brain than we are. And hence we hand over that component of the management to Nick. And we hope that between this EM exposure and that search for global multi-baggers, what we're really looking to do is give us a little bit of an alpha edge without taking excessive risk to individual companies. So how's the fund done? Just moving on to the next slide, if I may, Pete, thank you very much. So yes, what are we aiming to do here? Double-digit compound returns. That's what we've done over the last number of years. Certainly one of our longest-standing portfolios. In a sense, as Pete mentioned, markets at all-time highs. How do we feel about it now? In fact, if anything, I feel that this is the time that this fund is going to prove its mettle. It's felt a little easy, perhaps, when the tide's been lifting all boats, to think that delivering these kind of returns are easily achievable. I certainly believe as we go forward, this compounding power of the companies that we select and form the bulk of this portfolio, essentially the high ROCE businesses, are going to prove their mettle. Yes, valuations may be high, but as Pete mentioned, time heals. These are the businesses that are able to compound their way out of high valuations. And I'm certainly a lot more comfortable owning a portfolio of these businesses than a number of low growers that you have to really get your timing right in terms of entry points. Otherwise, you find that you will underperform. So certainly, we're very excited about what this fund will represent. And as I say, believe that this is the time it's going to prove its mettle. With that, I'm going to hand back to Pete. Thank you.
Great, thank you, Mark. So I think you can see that, once you get down to ground level, we're certainly able to identify companies that we're happy to be invested in, and obviously trying to avoid the excesses of the market. Those kind of those returns of 14% per annum compound over the period of 8 or 9 years. We don't think that's probably achievable over the course of the next little while. But as Mark indicated, we've got some cash on the sidelines ready to take advantage of opportunities. As we move across the globe, the developed markets tend to be our kind of bias. And if you looked at that portfolio, you saw what's happening there. Nick tends to invest in, I guess, more emerging market companies. But it's very easy to get excited about emerging markets. We spend quite a lot of time looking at them. And Liam Hechter out of London is going to talk through a little bit more about emerging markets and how we approach them.
Thanks, Pete. Okay, so our emerging market process definitely leverages off the broader investment process of anchor capital, and we apply the same disciplines. I guess one nuance is that from an EM specific perspective is that we apply some more sort of top-down sort of views or take a look at those attributes of the different markets. And I think that, if you could sum up why you should be paying attention, at least to some degree, in terms of what's going on in emerging markets, I would sort of broadly summarize that, take a look at the number of people living in those markets, the growth coming out of those markets, and then try and factor forward, project out where the world and global share of GDP will come from, and the sort of trend that you will probably see over the next 10, 15 years. And I think, particularly from a guy who's thinking very long term in this industry, I would imagine that emerging markets are going to continue to take additional share of global capital, the attention of the world, and as particularly places like Southeast Asia and China and India emerge, it would be remiss of us not to be paying quite a lot of attention in terms of the opportunity set available. And I think, if you're looking at investing outside of South Africa, you tend to gravitate towards probably more Western cultures and news flow that you would see. And I think that it's better, or it's a good idea for people to be paying quite a lot of attention in terms of the development that's really going on outside of the developed markets, and in terms of just the sheer sort of emergence of the emerging markets over the last 10 years. I think the trend likely continues, and there's many sort of factors and specific attributes that you could probably follow over the years in terms of just staggering growth and sort of opening up of these markets and industrialization of some of these economies. So what are the main attributes we're looking to capture? I think rising income levels of quite a low base is definitely one of them. We want to see young and growing populations, and the life expectancy of people and general living conditions getting better. And if we apply some of the disciplines that we've learned from the South African example, if you go back 20 years ago in terms of opening up economies, which is the gradual sort of trend that's happening in emerging markets, I think that if we apply and project out with the right leadership and policy, I think that the opportunity set could be quite significant over the next 10, 15 years. So that with that sort of top-down backdrop, we then apply a bit of a framework that we overlay to our existing stock picking framework within the broader anchor process. And we go into each market and we'd say, how do we capture and what are we trying to capture in each market? And I think that we'll still gravitate towards those businesses that we think are platforms that have the ability to become either the biggest or sort of top 5 company in their particular markets. And we are going to gravitate towards growth and scalability. We'll apply those same disciplines once again. I'm repeating some of the sort of key tenets that Mike and Nick have already spoken to. So very much a mini version of what we apply in the high street equity mandate, but then looking a little bit deeper. And I think that what we've also tried to do across our emerging markets product set is go after specific outcomes as opposed to try and capture something that's constructed more from an index point of view with legacy businesses that we typically wouldn't try and invest in. If a lot of these economies have been built off the basic material sector and their primary exporters and the like, while those affect the on sort of economic growth, what we were trying to capture is a second derivative of that in terms of the growth in the consumer and the opportunities that we've identified over the last 3 years in the space have been really encouraging, and I guess that we hope to see that trend continue. So those, these are some of the companies we own. They all have very similar attributes. We'll dig a little bit deeper into one of them that we've owned for about 3 years now. It's on the next slide, Pete. So Tinkoff Systems is a digital bank in Russia. I think what was encouraging about this investment for us was our application of what we had seen in other markets, some in the US, in Europe, and also in South Africa, in terms of the levels of adoption and disruption that can come through from a digital bank. I think that this is obviously one of the more sort of global secular themes that are playing out in terms of the ability to leverage higher returns through using fintech and obviously permeating through so many different facets of our life. The use of technology, I think financial services is definitely one big beneficiary of that. So Tinkoff Systems was a bank that when we first looked at it, we couldn't believe that there was a business out there the size that it was already. I think at the time that we invested in, they're probably sitting at 6-7 million people, and it was already the largest fully digital bank in the world. And what we've noticed or what we've seen is, with companies like Capitec taking on that additional market share as a low-cost operator in the market, the income statement shifted completely from one being of purely starting out as a lender to one of diversifying its revenue streams. And over the last year, what Tinkoff in Russia has managed to do is become the largest online broker in their market. So very much an ecosystem, a financial ecosystem that starts out as a lender, but has very successfully managed to diversify their entire business. And just this is one interesting example, and it's been a good outcome for us. But these types of investment opportunities we've managed to identify across the various markets, but with a narrow focus of trying to capture the attributes of that market that we find attractive, without trying to construct portfolios that are quite benchmark cognizant. Ours are very concentrated portfolios, very long-term focus, and that allows us to absorb additional volatility and obviously the emerging markets you're going to get thrown around by things like increased political risk and capital inefficiencies within those markets. And I think that taking a longer-term view, sort of trying to go after an outcome that takes advantage of a secular trend, is something that we have adopted as a process here at Anchor.
Thank you very much, Leo. So I think it's obvious that there's some great opportunities from an emerging market perspective, and we love finding those, identifying them, and getting close to them. I think Liam's approach is typified by a lot of hardcore investment research, talking to brokers all around the world who cover these companies, and that's certainly manifesting it in great performance in our emerging market portfolios. We then, as part of our team, one of the guys who's been with us pretty much from the beginning is David Gibb. He runs our technology fund and our worldwide flexible fund, which has delivered consistent returns in line with what he set out to do. David is quite a conservative fund manager, a very deliberate investor, and I think certainly, I don't have the stats to back this up, but probably one of the least trading in a fund in the whole market from a South African perspective, where he takes a position only when he truly believes in it and sticks with it for a long time period. David's got, again, a fairly unique investment approach and style, but I'll let him describe that and how he goes about finding the opportunities, which we certainly feel in his fund are out there in the globe.
Thanks, Pete. So here we're talking about the worldwide flexible category, which is where basically you give us your rands and we invest that for you offshore. So I think some people quite like the convenience of these worldwide flexible funds. Obviously, if you withdraw the money, you're going to get rands back. I mean, we'll obviously, convert investments back into dollars and then back into rands. So that's the one thing. But I think the other thing that's important about these worldwide flexible funds, and certainly in the case of this fund, I mean, I'm very conscious of rand returns. Obviously what we've had since April of last year, where the rand hit a very weak point and it's basically strengthened consistently up until a couple of weeks ago, is, you can give back a lot of your returns. So one of the things we try and do in this fund is we do hedge the currency from time to time. So in April last year, we took a view on the rand based on Nolan Wapenaar's rand purchasing power parity model, and we hedged 40% of the portfolio. And then as the rand strengthened from that point, we basically unwound all of those hedges in January of this year. So, I mean, we're just on that note, I mean, where are we on the rand right now? I still have a little bit of rand exposure in this fund, not through hedges, but through cash, some rand cash, but it's just around, the 10% level. So, I mean, if we just talk broadly about what we're trying to achieve in this fund, I mean, we're really trying to make investing offshore as simple as possible. I mean, it's very difficult to do. And the approach we adopt here is to buy things that are durable so that we can hold them for a long period, minimize the number of decisions we have to make. And when do you do that? When do you invest? Well, I mean, we've been very fortunate in having this down in the business cycle with COVID. So we've made a number of investments in this period down, I think where things were very depressed, very nice assets like Boston Scientific, which one of my colleagues, he came up with that idea. Or you look, which doesn't really refer to the current situation, but, where companies have made a mistake that's not too serious, or where growth is underestimated. And, I mean, that probably is more, typically those were the growth shares, that, the tech shares where we underestimated growth. But I think maybe finding some of those shares now in the typical value counters. So we've been buying a lot of value shares here over the last sort of 8 months. As you could buy growth really on the cheap for this economic upcycle. So that's the main part of the fund is A, right? I refer to A, which is probably 90% of the fund on average. And then A plus is something we added in recent years because we focus so much on tech investing. I thought we should, occasionally invest in a handful of disruptive tech companies. And we have done that. Our first, I think, was Spotify quite a while back, a couple of years ago. And then we've added other things more recently, like Delivery Hero and Mate1, we added last year. So this A+ is, obviously it's a lot more risky, but all these companies have the hallmarks of durable companies. They have very high market shares, and they run by visionaries. So at the moment, we are not really finding many opportunities in that category. We did invest in Delivery Hero recently in the last few weeks. So I think there's been a sell-off in some mid-cap tech shares, but generally not finding that much value in that area. Next slide, Pete. So, if you'd like to try and understand the style that we use, most people like to think of growth and value investing, right? So if you look at the West Coast of America, it's typically, that's Silicon Valley, just outside San Francisco. That's really the home of growth investing. And it was made popular by this chap, Philip Fisher, who wrote that book, Common Stocks and Uncommon Profits. And frankly, we've had such uncommon profits in the last few years that value investing has had very little attraction. And value investing, I often refer to as East Coast investing, was made popular by Benjamin Graham, the intelligent investor. Typically here, you're talking about companies with heavy assets. They've got a lot of infrastructure assets. And so it's this is the traditional style. Growth investing really came about in the 1980s. And most people struggle to straddle both styles. If we move on to the next slide, Pete. But based on my experience and the experience of quite a couple of us in our team, we do both. And particularly in this fund, we're just as comfortable buying Delivery Hero, which is in fact not based on the West Coast, but it's run by someone, Nicholas Osberg, with very much a West Coast mindset. He's based in Berlin in Germany. So it's achieved dominance in the Middle East. This is in the food delivery category. And in parts of Asia. So a great visionary, and Naspers, obviously, they have a stake in this business too. And it's come under a lot of pressure recently. So, I've introduced a new position in this company. I still think it offers pretty good value. And then if we think of the East Coast, here we're talking a company, Verizon, which is capital heavy, trades on a very low multiple, so probably 11 times earnings. And I think last year it was the second biggest investor in CapEx in the United States. So we're talking heavy assets here. It's not an intangible company, which is pretty much what West Coast companies are like. So we're very comfortable investing in both East Coast and West Coast. And frankly, I've been investing more on East Coast recently. I think it's, certainly over the last 6 to 8 months, much better value there. And if we move on to the next slide, it's strange. We've had such a long economic upcycle. Prior to COVID, I think it was the longest economic upcycle in decades. So, the reality is we are going through a new economic upcycle, and it's the first since 2009. And where you can buy growth on the cheap from more cyclical companies, often just as durable as the growth companies that we're used to. So, obviously I'm showing the red arrow there where I think the physical economy is. Some economies are bigger than they were prior to COVID already. I think there are 5, including Lithuania, South Korea, Australia, and China. But generally we've got an economic upcycle, and it has provided an opportunity to invest in companies on the cheap. So I've certainly done that in this fund. And if we just turn to our last slide, how have we done over time? Our benchmark is a CPI plus 4. We've obviously done quite a lot better than that over time. I mean, this was one of the first funds that invested offshore in the anchor stable. I've run it since inception, and I think we've expanded our range. And, you know, you don't have to worry that you're going to be too exposed to one part of the market. We will pick the most attractive areas for you, and we will also take a view on the rand. So now we're typically happy to not be invested in the rand, but to pick more of the value areas and occasionally add to more growth shares if there's enough value in them. So on that note, I'll hand back to you, Pete.
Right, thank you, David. So if you don't put money into equities, what do you do with it? I think that's been one of the big questions, one of the issues for investors who externalize capital. So I'm not going to answer that. I'm going to hand it over to Nolan Wapenaar, my co-CIO and head of fixed income, to talk to you about global income.
Thank you, Pete. Very much as an alternate asset class, something different. Up until now, we've been talking different equity markets. We also have fixed income. Fixed income is generally seen as the more boring asset class, and it's seen as the more boring asset class because the returns are generally lower. As Peter was saying earlier, we're talking about 2 to 3% returns in US dollars, which is far less exciting. But the reason that this asset class is still attractive is that the volatility is also lower. It can be and should be a sleepier asset class where it's unlikely to surprise you. You're unlikely to see massive value swings within the actual asset class. And therefore, it's just, frankly, a lot more stable. And that gives it some very, very attractive properties. So why fixed income? Why look towards it for diversification? Well, the first point is exactly what I've already mentioned. It is the stable portion of your portfolio. So for many investors who don't want to have the full volatility of equity cycles, they look towards fixed income to be the stable foundation upon which their global investment portfolio is built, so that you've got a portion of your portfolio that's dependable through thick and thin, I guess. In terms of why else, I'll let Peter Little, who's speaking after me, add to it, but fixed income is a counter to equities. So what I'm saying here is that fixed income tends to perform well, certainly abroad, when equities comes under pressure. And we've actually seen that in the last few days. Bonds are showing some of their highest valuations in the last 3 months today, and equities have just hit a bit of a speed bump. So you've got this counterbalance to your portfolio that brings about a lot of stability, and it brings a lot of diversification benefit. And then finally, sometimes fixed income just acts as a very useful store of value. If you want to take your money abroad, you, for whatever reason, can't stomach the volatility from the equity markets, you're just looking for somewhere that you can put the money where you know it's your rainy day fund. Perhaps fixed income serves a very useful sort of purpose there as well. So those are the main reasons. But if we look at the next slide, how does Peter, I don't know if you can flip the next slide there. How does Anchor think about fixed income? And the way we look at it is the tortoise and the hare approach from the fable that we're all familiar with. Our fixed income portfolios are very much the tortoise. We want to be the steady Eddie portfolio that just invests in fixed income. In other words, what do we really do? We make a bank loan to a well-known bank. We invest for 3 to 5 years. We sit there, we earn our interest income, the loan matures, the bank pays us back, and we go back into the market and make another loan to that bank. Unfortunately, it is dead boring, which is exactly what fixed income is supposed to be. But we just don't believe in all of the sort of fancy, flangled ideas that one sees, which I think sometimes more marketing oriented. So we're not looking there with massive option strategies, massive gamma strategies, theta strategies, all the other things that abound offshore. We very much take the view of just keep it simple, keep it something that you can explain to someone and understand how their money is invested, and just do what you're supposed to do, which is earn a steady, stable income stream for your investors. So ultimately, why anchor global income? Firstly, our portfolio is 100% US dollar denominated, so we're not mixing currencies, you know what you're getting. We're investing in a portfolio that's got an average rating of BBB. Now, bear in mind, our country is actually BB minus, so the Global Income Fund is actually rated better than the South African national government or anything issued in South Africa. The portfolio inception is quite recent, and but it continues to perform well. So in that regard, the portfolio has been invested mainly in developed markets in the US and Europe, and we've got to focus on those regions because we believe that South Africans looking to invest abroad are looking for more stable outcomes, certainly from this aspect of their portfolio. The portfolio targets a return in the current environment of 2 to 2.5% net of fees for the investor, and that is actually a lot better than just putting your money in a bank account where you are earning zero. And in fact, if we go and look since inception, the portfolio has returned over 2.5% on an annualized basis. So it's actually slightly exceeding its target. From that perspective, we do believe that this forms a useful part of a broader global asset allocation. But I'm going to hand over to Peter now.
Thanks, Nolan. So that certainly gives an idea of the opportunities that are available out there in the non-equity space. Obviously, returns are quite hard to come by. But certainly, we would, as a default for people who've made pretty nice money over equity markets over the course of the last 5 to 10 years, it probably is time for a little bit of caution, given the risk-return kind of equation out there. So if you want us to do the job of deciding whether to put your money into equities or fixed income and the like, we run balanced portfolios. And Peter Little has been a great team member over the course of the last 7 or 8 years in helping us look at markets strategically and managed portfolios. So Pete, I'll let you explain a little more.
Excellent. Thanks, Pete. And thanks to everyone that's joined. I must say, I think I've got the graveyard shift. I think Pete's going to wrap it up. Pete Armitage will wrap it up after me. But I was fully expecting to be well over an hour into this by the time we got to me. So well done to all the presenters before me. So as Pete said, I'm going to look at things. You've heard about all the buckets coming up to this. I'm going to talk about people who don't necessarily fit neatly into one of those buckets. If you want some blend of the things you've heard about before, that's kind of where I come into it. A few of the guys have touched on this before, but just for perspective, I've put South Africa into the global context. And so, any which way you look at it, we're sort of less than 1% of the global population, less than 1% of global GDP. Our stock market's less than 1% of the market cap out there. Even the stuff where we over-index, like bank stocks, where we're sort of almost 2% of global bank stocks. We have 5 or 6 banks here. There's about 180 banks to invest in offshore. So you really are spoiled for choice once you get outside of our market. And it helps us from a perspective of there's lots of things that we can't do with your rands in South Africa that we can do offshore. Nolan touched on the fact that our government's sub-investment grade, there's a $50 trillion investment grade bond market out there once you take your money outside of the country to delve into. So there's really a whole lot going on out there. And so on the next slide, I'm just going to talk about once you've kind of figured out where you are in the world of how much return you're looking for and how much risk you're willing to take, and Darryl and his team will kind of talk you through how you get to that place. This is philosophically how I look at the world. So on the right-hand side here, I've got that funnel which says, we've got a return objective to achieve every year, and we're going to achieve that with some combination of capital and income, capital growth and income. And then the way I kind of think about achieving that capital growth and income is on this continuum, this sort of palette of opportunities that we have across this chart on the left-hand side there. If we start off on the bottom right, so high degree of certainty, low potential return, and then sort of moving across to your top left where you have a lower degree of certainty and a higher degree of potential return. These are the components that we want to juggle together to get your outcome, because ultimately we have a huge amount of choice and we really need to focus on the outcome so we're not distracted by everything going on out there. So if I think about the stuff in the gray boxes down the bottom right, where you have a reasonably high degree of certainty, that's where you have an instrument that has a contractual obligation to pay you some income. So either your bank or the government who you've lent money to have a contractual obligation to pay you some income. And as you move sort of from right to left on that chart, the probability of those players being able to meet that obligation reduces. So the government, obviously in developed markets, pretty good chance they're going to give you your coupon and your capital get back. As you move to the left of that, you've got investment grade corporates. These are the credit-worthy guys. Reasonably good chance you're going to get your money back from them as well. And then you're moving into the high yield space, the junk bonds. Here you have the chance that they might not meet their contractual obligations. So you're going to get a slightly higher return by investing with them. But with slightly higher risk. And then you move into the blue boxes, sort of towards the top left of that chart. And that's where there's no contractual obligation to earn income. So these are companies or listed real estate companies that will typically pay you income in the form of dividends. And there's no contractual obligation to pay that dividend. So there's no certainty around you achieving that. But in exchange for that certainty of income, you're getting some capital growth, which you don't get in the bonds. So the bonds, you get your income, but it's not going to grow. In this blue part of the chart, you're going to get some growth, but not necessarily certainty of it. And even within that, there's a continuum. And you've had the different guys talking about different types of companies that they look at. And here, the way I kind of think about it is in the mature industries, you have companies that are going to just pass most of their income through. These are saturated markets. They don't have much to invest in. And so they're going to, be able to grow a little bit with pricing power that they might have, or they might have cost efficiencies that can help them grow their earnings. But by and large, they're going to grow at a sort of very low or moderate rate and pass through most of that cash. And then on the top left of that thing, you're going to see companies in emerging industries. These are the sort of multi-baggers that Nick was talking about, or Liam, the kind of companies they're looking at in emerging markets where you have huge runway for growth, not necessarily passing a lot of that through in the form of income just yet, but obviously lots of capital growth. And that's kind of how we want to blend these different asset classes together to achieve an outcome that suits your needs. And the slide that we're looking at here is one of the mandates we've been running for 6 or 7 years. This is a dollar mandate. We're looking to get about 7 to 9% in dollars there. And so you can kind of see the math in this table at the top here is that we're going to need to get quite a good chunk of that. About 2/3 of that's going to have to come from capital growth. And so this is the type of mandate where we're going to need to put in a healthy amount of equity and a bit of listed property. So about 2/3, almost 70% of that mandate is going to be invested in risk assets and equities and things like that, and the rest we'll get from income. And then on the flip side of that, on the next slide, there's a mandate that's slightly more conservative of nature. Pete, if you want to page over to the next slide. And this mandate is just looking for sort of 3 to 5% in dollars, which is more than double the inflation rate at the moment. And this is for investors who either more conservative in nature or feeling a little bit nervous about where valuations are right now. And this type of mandate, we can get, almost half or slightly more than half of the returns from income here. So we don't need to take necessarily a lot of risk to get that outcome. And that means that we can put sort of a quarter to a third of the assets into growth assets there and get most of the return from the sort of contractual obligations of the issuers who we lend money to. And with that, I'm going to pass us back to Pete to wrap it up.
Great, fantastic. Thank you very much, Peter. So I think you can see that while we do have some anxiety about prospective returns and risks that are inherent in markets at the moment, there's a lot of hard work being done right across the mix, and you can see a lot of the guys are identifying opportunities. So often looking at things at index level can be a little misleading. Certainly if you look over the course of the last year, there were times when the index wasn't looking that exciting, but within that there were shares that were doing incredibly well, and shares that had peaked and come off quite sharply. And we've got a range of fund managers' approaches and an investment process which aims to identify opportunities which we think at any point in time still offer a great risk-return perspective. So that's the story from all of our fund managers. If you'd like to ask a question or pose a question to any of the guys, please feel free to go into the Q&A at the bottom. I think at the moment in global markets, all of the talk is about inflation. Is it transitory? We're seeing some massive numbers coming through in America. Bond markets are seeming to suggest that a lot of it is once-off in nature. But I think a conversation of this type at this point in time, we can't help but talk a little bit about inflation. Nolan, perhaps you'd like to kind of expand on the view that we've been expressing, and Pete, if you'd like to add to that as well.
Yeah, sure. So in terms of inflation, the example I often use is if you cast your mind back about a year, it's a year and a bit now actually, to April last year. The oil price was below $20 a barrel, and we had this absolutely crazy phenomenon where the future closeout was negative. In other words, you had to pay people to take oil from you because you didn't want to pay the storage costs. Roll on a year later, oil is back at sort of in the $50 to $70 range most of the time, and that's traditionally where it's been. So we saw this very low value in COVID. And what you've really seen is a recovery from base effects. On top of that, you've got unlock inflation where, similar to the oil price, it was very depressed. You've had airline tickets that have been very depressed. You've had other services and other goods that have been very depressed. And as we unlock, that's creating a sort of recovery inflation taking place. At the same time, we've also got supply chain blockages because we're not unlocking global economies all at the same time. So, there was a big sort of bottleneck in terms of getting chips to automakers so they could manufacture enough cars. And that meant that people who needed cars were forced into the secondhand car market, and secondhand car prices went up. Those are kind of one-off things. I don't think the value of a secondhand car is going to keep going up by 15% every year. And instead, what you've got is those are the transitory inflation type stories that people are talking about. The question, though, is, are there other factors that actually become sustaining inflation? And we need to look out very carefully for those. And I think the two or three we spend most of our time looking at are US wages, where we are concerned about wage growth. It's a big challenge right now in the US because people are still getting stimulus checks, which means they're more inclined to stay home than go into very low-paying jobs, and low-paying jobs are therefore seeing wage inflation. We are seeing, the cost of houses in the US go up quite significantly. I think housing prices are up something like 15%. That is potentially concerning as well, because that means that rent prices and so on start feeding into the inflation basket. We do think that the inflation for shelter is going to about 4%, and that has a possible risk of becoming self-sustaining. So it's those types of inflations that we are concerned about. At the moment, we are not seeing them manifest. All the inflation we're seeing coming through is this transitory inflation. However, we've got to be very, very sort of aware of the fact that can change quite quickly. Though for now, Anchor is taking the view that inflation is going to spike up in South Africa, in the rest of the world, but it'll actually roll down pretty quickly as well. And the central banks are saying they'll look through that. So basically, they're saying they're not going to hike rates at a frantic pace, and it's going to be slow and measured.
Pete, have you got anything to add there?
No, I think Nolan's done a great job of explaining it there. I think the only things I would add there is, the last time we had meaningful inflation was probably in the 80s, at least in developed markets. And so most of us have not had particularly good experience at investing in the 80s, but the structural forces that were around then are not present now. We don't have the same level of massive demographic growth in developed markets there. We didn't have the global networks for supply chains. So I think we certainly, I don't imagine we're entering an environment where we're going back to the sort of teen inflation that we saw in DM over that time. But I do think what we've been spoiled with particularly low inflation at the moment. So I think it, and this is what Yellen was saying last week that spooked the markets a bit. A little bit of inflation would be pretty healthy, in that it would indicate that there's demand growth, and that's a pretty good thing. So I think we should be glad to see a little bit more inflation, but not terrified about inflation running away.
Cool, thanks. So an interesting question, and something that gets posed to us quite often. And Pete Little talked about emerging industries and emerging sectors. The question is posed as follows. Hi guys, thanks for the presentation. What's your view on the onset of new technologies in biotechnology, gene editing and health technologies, which has been increased with the onset of COVID-19? Are there any particular counters we could look into? So perhaps I'll pose that to David Gibb and to Nick Dennis. I know they try and look into the future as much as any fund manager in our business, and try and, I guess one of the challenges is always, a lot of these new technologies and new ideas don't yet make money, and it's not clear exactly what the business model is. But Dave, maybe just to give us an indication of how you view or approach the companies of 10 to 20 years time.
Yeah, so we've got some of these investments in our global tech fund. So gene editing, a very interesting field. And, you might have heard of CRISPR, which has, become this revolutionary method of adjusting, people's genes if they have genetic abnormalities. So we have an investment in a company called Intellia Therapeutics. The code is NTLA, which we bought last year in about March. I mean, it's up about 8 times. None of these, typically in the CRISPR category, not many of the companies have commercialized their products yet, but they're certainly making great progress in bringing products closer to market. So I think that is, it's a very exciting area. So, there are 3 that are worth considering. There's CRISPR Therapeutics, there's Intellia Therapeutics, and there's another one called Editas. Those are the 3 well-known ones. We went with Intellia, and in fact, it has been by far the best performer of those 3. So, that's CRISPR. In fact, there's a lovely book that's just come out by the chap who wrote the book on Einstein, Walter Isaacson, called the Code Breakers, if you're interested in the topic. And then, I think other areas in healthcare. Well, we haven't invested in Teladoc or any of those sort of healthcare services where you don't actually physically consult with your doctor, but that's become very popular too. We'll have to see how popular it remains. I think people might want to get back to their doctors and see them in the flesh. But there are, there's a host of, and I'll maybe leave some, maybe Nick would like to talk about some other ones if he has some ideas on those.
Unfortunately, I don't, Dave. I find there's so much there's so much still to do, and like so many interesting names in the space that I do understand, that for now I don't need to venture into the areas that I don't understand to do well. So I agree. I think all of that stuff is fascinating. I think there's a lot to come. It's just, it takes a long time to develop deep domain expertise, to develop the conviction in these companies. So it's very easy to like read an article and say that's interesting and then buy a position. But like typically that's not what we do. And the problem with that is it's fine when it works, when it's working, but when you're down 30%, how are you going to know if what you own is the real deal, or like so like it's really, the research element is really important in developing conviction and understanding. And so, yeah, I mean, a lot of the spaces, it's sort of, I can see myself doing plenty of research on it in time, but I just haven't got there yet today, just because there's so much that I can understand already, and that's investable.
Nick, I'm going to try and floor you even more. We've got a question. How do you think investments in space exploration will perform within the next 10 to 15 years? I think your answer is pretty much going to be the same as that's something we'll probably leave for our children to invest in, I would imagine.
Well, so look, I mean, So SpaceX is not public yet. That's Elon Musk's company. You can invest in Virgin Galactic, which I haven't sort of looked at. The Anchor Global Equity Fund has got a decent sized position in Tesla, and I'm hugely bullish on Tesla. And I think Elon Musk is phenomenal. So, just betting on him, I can see why after it lists, it could have it could be a really good company for 10 to 20 years, but it's not listed. We don't have any metrics. So at this point, it's just pure speculation.
Thanks. Liam, a question in the emerging market space. Tencent Music. David talked about Spotify. We've made a lot of money across lots of different portfolios in Spotify. The Archegos, the forced selling by that hedge fund, saw a selection of 4 or 5 quality companies get sold off, and that included Baidu, Tencent Music, and the like. Any views on Tencent Music? I think just to run through the metrics of it, which I think are phenomenal.
Sure. I mean, I don't have my screens open now, so I can't give very specific metrics on it. But we actually participated in the Archegos liquidation. So it was a Friday afternoon, and our prime brokers here in London we didn't actually know what was going on at the time, but it had been building up for a couple of days, and we had watched Tencent Music go up quite aggressively in the first couple of months of the year. There was it looked like completely abnormal behavior for a stock to demonstrate. We didn't participate on the up, but when it did get liquidated, it was a stock that's been on our radar for a while. We actually participated in the sell from Baidu as well in China. So Tencent Music, I think you can draw some similarities to Spotify, particularly in the application. But I think where the difference is Tencent Music is a huge music ecosystem, obviously backed by Tencent, and up until now, it's been largely unmonetized. So where I think in the case of Spotify, the thesis also hinges, and correct me if I'm wrong, in terms of taking the unpaying subscribers and converting them into paying subscribers and creating some kind of value proposition. I think in the case of Tencent Music, all the revenue that they were generating up until quite recently was in the form of tokenization. So you effectively on a music platform, and your friend is singing karaoke, and you effectively buying tokens to reward them for their good singing. There was that kind of element to it. So I think you can't draw a direct comparison, but I think that the same usage application applies across. And what's come through quite strongly probably in the last 6 or 7 or last 3 or 4 reporting periods is that they're converting this huge, close to probably 1 billion people who have downloaded the application into paying subscribers, and they're still in the very early stages of that. So in terms of paying subscribers, I think you're growing somewhere like 50% per annum, and the thesis largely hinges on conversion of paying subscribers or unpaying subscribers into paying subscribers, and on a multiple basis, you're not overpaying for Tencent Music. I don't think you're not in the same sort of moonshot valuation territory as something else where you're paying for sort of year 6 and 7 growth. But I think that's a common theme across a lot of emerging markets and the sort of tech platforms in EM, particularly in China. They're a lot cheaper than you would sort of use in the developed world comparison of their enterprise. I mean, you look at Russia and China, it's very similar, and maybe not Mercado Libre, but definitely in Russia, China, Southeast Asia.
Liam, while we got you there, and it's pretty much it's on a similar theme, a question posed about big tech in China and the clampdown from China on the likes of Alibaba, Tencent, etc.
Yeah, I mean, just some context. So these businesses have become huge in their respective markets and very, very sort of dominant in terms of the role that they play in the economy. I think China is a centralized sort of governance structure and not necessarily a democracy like we used to in the rest of the world. They want to feel like they're more in control of the way things develop out. I think that as the dominance of these big tech platforms came through, it was a natural, probably just a natural move for there to be a more sort of, more scrutiny in terms of what these businesses do and how they behave, and not effectively crowd out competition by buying up any competitor and creating some completely concentrated market position. I think one probably misunderstood or misinterpreted factor in terms of what actually goes on in China is that there has been quite a lot of competition. It hasn't been monopolies running away with themselves. I think the bigger companies compete quite heavily with each other. So I think that's probably one nuance, that everyone just assumed that investing in China, they'll look after their national champions and let them flourish, and as long as they keep quiet, the government will let them do their thing. But actually underneath, below the surface, there has been a lot of competition, and I think that a lot of the negative sentiment gets amplified by the tensions between the West and the East, and sentiment just generally towards China. I think that as soon as you start, fundamentally these businesses are still very strong, and as soon as you start, the narrative changes back towards the operating results coming out of these businesses. We think that the way that the shares are trading will probably form some kind of base and start re-rating again, because ultimately these are exceptional businesses, and right now we think that they're offering exceptional value. So we're along a majority of it.
Darryl, one for you, more from a structure perspective. A question surrounding the ownership of shares directly offshore, and does it make sense from a Citus and other perspective?
Yeah, so Pete, as I mentioned earlier, I think this is going to be covered quite extensively in a later series in the webinar, but there are very much certain taxes, and quite punitive taxes, that foreign investors aren't necessarily aware of when they're investing in offshore markets. Citus was the one that was mentioned in the question. Long story short, as a foreign investor in the likes of the US owning shares directly, on death, you are potentially liable for up to 40% death duty, rather than somewhere between 20 and 25 that you would pay to the South African receiver. And that's on gross assets. And that's why I mentioned earlier, getting the structure right up front. And it obviously depends on what assets you're going to be investing in, but listed shares are 100% Citus assets. So well worthwhile considering that when you're making those investments.
Pete Little, a direct question, I guess, about income versus equity markets. With inflation expected to come through in 23-24, does it make sense to invest in income funds for a period and await a significant equity pullback? I guess that's the question we get posed with every single month of our lives when we sit in equity markets.
Yeah, so I think that's the question on everybody's mind. And look, at the asset class level, I don't think there's any free lunches. So to the extent that we do have inflation coming through, it's bad for bonds. To the extent that makes yields go up, it's bad for equity. So it's all kind of interrelated. What I would say is that the question, the question was posed the right way. We're expecting to see inflation coming through in 23-24, and markets don't have to wait for that, right? We're already expecting it. It's already in the price to a large extent. What we need to worry about is inflation coming through ahead of expectations. So, if we get runaway inflation that's dramatically more than anyone had in mind, that's obviously something that's not particularly exciting, whether you're a bond investor or an equity investor. I think what we have seen is a willingness for the central banks globally to act in a coordinated fashion to get ahead of this curve. So to the extent that inflation sort of does get out of hand, I think we will see monetary support and kind of things getting managed well in those environments. So I take a lot of comfort in that, and I think we had a great example last year in the pandemic where the Fed actually, or the central banks in Europe and the US stepped in and provided liquidity to the corporate bond market, which we've never really seen before. So it gives you kind of a lot of confidence about the liquidity of the underlying assets, and I think there's already an expectation that we're going to see inflation, and so I think we're fine. Unless it surprises dramatically to the upside. And in that situation, as I say, I don't think there's any particular hiding places. I think asset classes will all suffer there.
Mike, is it something that you take into account when you're putting together a share portfolio and investments? Do we just kind of look at it from a bottom-up perspective and try and assess the impact of inflation in companies? Obviously, for some companies, if they can pass prices on, it's pretty positive. But to what extent is that taken into account in the formulation of a model portfolio?
Yeah, thanks, Peter. I think that other Pete answered that question particularly well, along the lines that, we have to trust the fact that markets anticipate this. And I do strongly believe that it's the degree to which the outcome that we eventually see is different from what's already anticipated that's probably going to be most influential in, how investment markets in general perform. But certainly in terms of sort of how I see the world, I keep coming back to that issue of compounding and growth. And while I accept that there are areas of the market that are certainly looking a little bit stretched from a valuation perspective, I also think that, when you think of investments that you want to be in for the longer term, and that's an important point in terms of not necessarily trying to constantly be second guessing the next move, because invariably there's always a reason not to be there. But just trust and time to take care of valuation, to take care of your returns. And certainly I would far rather be invested in, businesses with strong moats, that ability to compound returns over time, and trust that, their growth will, in the fullness of time, compound their way out of what may appear to be slightly inflated valuations, if that's the case. So it's a lot about the bottom-up selection of stocks that you pick. And, as I highlighted in my brief discussion earlier on, I think it's actually in times like this when perhaps it's not so easy that the sort of success of picking those individual stock winners really does come through, and the sort of thought that you put to that, that's when it proves its mettle.
Okay, I think we're pretty close to wrapping up. Maybe to end off with a question to Nolan. So, to hammer down and put an actual number on it. Global income, 1 year forward return, what do you think is reasonable? What do we think of the currency 12 months out? And then a question on inflation-linked bonds, and whether that's a place to be given what's happening with inflation and potentially interest rates.
Okay, that's actually quite a wild array of different topics to cover. But very, very quickly, this crisis, the COVID crisis, economic crisis from COVID, has been different to most previous crises. Most crises, you go into a recession, 2008. Individuals, consumers' balance sheets were very stretched. It took them a while to recover. This time around, we went into the crisis. The American Fed pumped a lot of money into the system. It sent out a lot of stimulus checks. And many of the households actually came out of the crisis richer than they went into it, which means that their propensity to spend is higher. That means the recovery is faster. It means the cycle is quicker. And that's what we're seeing. We've seen a lot of it, and I think we will see more of that. That then feeds into how we look at these different asset classes. So what does that mean for yields going forward? The long and the short of it is that it doesn't matter if the interest rate get hiked or not for bonds. What matters is what is the market expecting. I think Mike touched on that earlier. At the moment, the US market, bond market, is expecting that interest rates will sort of peak at about 2%. So the Fed's going to hike interest rates to about 2% this cycle, and that's what the market is pricing in. So, one or two hikes in isolation don't really matter. It's what we're looking for is signaling that the market's going to be pricing faster. So that's what's going to impact these things. In terms of, if the Fed just plods along as expected, we see transitory inflation as expected. That's already priced in the market. Our bond portfolios are very short in duration, so they're probably going to return closer to the 2% yield over the next 12 months, and that's great. In terms of inflation-linked bonds, you want to buy those typically when inflation is going up. So if this philosophy, this view of transitory inflation proves to be incorrect, then inflation-linked bonds will become very, very attractive, and you'll start to see significant gains there. Unfortunately, inflation-linked bonds also price quite expensively, so you don't really want to hold them unless you've got them either as a hedge or a strong view that inflation is going to come through and it's going to be sustained inflation, not just transitory. And then the final question, what does that all mean for the Rand? Our fair value of the rand on a long-term basis is somewhere between 14.50 and 15. We think that that's the long-term value of the rand at this stage. Over time, that long-term value will slowly depreciate. But in the near term, the South African rand is supported by a variety of factors. Yes, the Fed was a bit of a negative last week. I think that'll blow over in time. The South African current account remains positive. That is supportive of the rand. Our interest rates remain a lot higher than the US. That is supportive of the rand. And once the sort of risk-off jitters that we're going through today recover, we still think that the rand will probably trade a little bit lower than our fair value in the near term. And in the long term, a year, 2 years out, it probably moves through that range again.
Fantastic. So thank you very much, everybody. And we've taken you a little trip around the globe and looked at asset classes and shares, and hopefully given you some confidence that there's still some great businesses and investments to make out there. And this is the first of a 4-part series in global investing. So make sure you invite it to the others. If you're on our mailing list, you'll get it. We're going to be talking a lot more about structure and approach from a global investment perspective, but we thought it quite opportune to give you the thoughts of the fund managers and the people who are actually making the calls on the money. So thank you very much. Keep safe. It's tough times out there. And we look forward to seeing you again later. Cheers.